Welcome to our webinar regarding the newly finalized Department of Labor Fiduciary Rule. This presentation will last about an hour and a half. Because of the enormous number of questions that we've received in advance of the webinar, we've extended the originally advertised time by a half an hour in order to address as many of those questions as possible. A recording of this webinar will be available on the Wagner Law Group website, www.wagnerlawgroup.com. You can access previous webinars on the website as well. Let me introduce our presenter, Marcia Wagner. Marcia is a specialist in pension and employee benefits law and is a principal at the Wagner Law Group, one of the nation's largest boutique law firms specializing in ERISA, employee benefits, and executive compensation. She founded the law firm in 1996. A summa cum laude and Phi Beta Kappa graduate of Cornell University and graduate of Harvard Law School, Marcia has practiced law for over 28 years and is recognized as an expert in a variety of employee benefits issues and executive compensation matters, including qualified and non-qualified retirement plans and all forms of deferred compensation and welfare benefit arrangements. Marcia was appointed to the IRS Tax Exempt and Government Entities Advisory Committee and ended her 3-year term as the chair of its Employee Benefits Subcommittee and received the IRS's Commissioner's Award. She has also been inducted as a Fellow of the American College of Employee Benefits Council. For the past 8 years, 401k Wire has listed Marcia as one of the 100 most influential people in the 401k industry. She has received the Top Women of Law Award in Massachusetts and is listed among the top 25 attorneys in New England by the Boston Business Journal. She has written hundreds of articles and 19 books about retirement and benefit plans. She is widely quoted in business publications such as The Wall Street Journal, Financial Times, Pension Investments, as well as many others, and she has been a frequent guest on Fox Business, CNN, Bloomberg, NBC, and other televised media outlets. Welcome, Marcia.
Thank you very much, and good afternoon. Today's webinar is on the DOL's new fiduciary rule, and as you can see, we have a lot to talk about. We have a very full agenda, and we will be focusing on 10 topics. We'll kick off our presentation with an overview of how the DOL's new rule is being rolled out and when the new rule will become effective. Next, we'll dig into the substance of the DOL's new fiduciary rule, which broadens significantly the definition of fiduciary investment advice. This is clearly one of the most groundbreaking pieces of rulemaking to ever emerge from the Department of Labor. The Department's new fiduciary advice definition is intended, in fact, to be extremely broad, but it also includes carve-outs or exclusions that are designed to ensure that certain providers and individuals are not inadvertently viewed as fiduciaries. We'll also be talking about the best interest contract exemption, as well as the special treatment of certain types of annuities under Prohibited Transaction Exemption 8424. We'll discuss fee levelization and Robo advice as potential compliance alternatives. The DOL rule is going to have a significant impact on both rollover practices and the managed account business, and we will be specifically covering these topics. We'll also include a practical discussion of what advisors, firms, and financial intermediaries should be doing to prepare for the new regime. By way of introduction, the DOL's new fiduciary rule is designed to broaden the scope of retirement advisors who are deemed to be fiduciaries under ERISA and the Internal Revenue Code, and is also designed to address the potential conflicts of interest that arise when they are advising their retirement clients. The scope of the new rule is far-reaching, and it specifically covers and protects IRA clients as well as plan sponsors and plan participants. As a formal matter, the DOL issued regulations defining what fiduciary investment advice is, and it has adopted a number of related class exemptions for prohibited transactions. The DOL's new fiduciary rule targets broker-dealers and their registered representatives. It would impact virtually all registered reps with any IRA or plan clients. In order to continue to earn commission-based compensation, registered reps will need to comply with one of the new exemptions. Virtually all IRA advisors will be deemed to be fiduciaries, and the new DOL rule is expected to change the IRA marketplace. The DOL rule will also impact registered investment advisors, or RIAs, principally in two areas. It would restrict their ability to capture rollovers, and it would also impose restrictions on retail managed account programs that are sponsored by their advisory forums. Before we dive into the new DOL rule, let's talk about the rulemaking process and how the new rule will, in fact, become effective. The DOL fiduciary proposal was published on April 20th, 2015, based on the thousands of comment letters that were submitted, as well as public hearings. The DOL modified the rule. The DOL finalized and published its new fiduciary rule on April 8th, 2016. The new fiduciary rule is actually a set of rules comprised of a new definition of fiduciary investment advice and a number of related releases providing new and modified exemptions from the prohibited transaction rules for fiduciary advisors. These prohibited transaction exemptions are also known as PTEs. Although the DOL's final rule was officially published on April 8th, it will not go into effect until April 10th, 2017. This one-year grace period is designed to give the industry time to adjust to the new rules, and it is consistent with the DOL's previously announced commitment to give the industry a lead time of at least 8 months. The related PTEs impose numerous conditions and requirements on fiduciary advisors. Some of these requirements will be phased in and become effective on April 10th, 2017. But many of the more onerous requirements will not become effective until January 1, 2018. Once again, giving advisors and other service providers more time to prepare. Under the DOL's existing fiduciary definition for service providers, you are deemed to be a fiduciary to the extent you provide investment advice relating to plan assets for a fee or other compensation. And once you are deemed to be a fiduciary, the provider becomes subject to a high standard of care under ERISA. The existing DOL definition has a 5-prong test. In order to be deemed a fiduciary providing investment advice, the advisor needs to make recommendations as to investing in securities or other property, or give advice to their value on a regular basis. There must also be a mutual understanding that the advice will serve as a primary basis for the plan's investment decisions, and that the advice will be individualized to the particular needs of the plan. The DOL position is that this definition is too narrow in today's world, allowing many advisors to effectively provide advice without having to answer to the fiduciary standard of care under ERISA. For example, an advisor could take the position that its advice is not provided on a regular basis, or that there is no mutual understanding that the advisor's recommendations will serve as the primary basis for the plan's decisions. Because the 5-prong test is so narrow, the DOL believes that it is too easy for advisors to escape fiduciary status. Therefore, the DOL is expanding the definition considerably to include a much broader group of advisors. As with the existing fiduciary rule, under the DOL's new rule, a person who provides investment advice for compensation would still be viewed as a fiduciary. However, under the new rule, there are 3 different ways or contexts in which an advisor will be deemed to be giving fiduciary advice. First, if the advisor acknowledges that it's acting as a fiduciary under ERISA or the Internal Revenue Code, its advice will be fiduciary advice. Second, if there's a written or even unwritten understanding that the advice is based on the particular needs of the client, it is fiduciary in nature. And third, if the advice is directed to a specific person where the advice relates to the advisability of the particular investment decision, the advice will be deemed fiduciary advice. In addition to looking at the context of the advice, you also have to look at the nature of the advice to determine if it is indeed fiduciary advice. Advice will be deemed to be fiduciary investment advice only if it includes a recommendation for a fee or other direct or indirect compensation. Under the final rule, the threshold question in determining if fiduciary advice has been rendered is whether a recommendation has occurred. The formal definition, like everything in the final rule, is somewhat complicated, but it can be boiled down to two types of recommendations to plan and IRA clients. First, fiduciary advice includes recommendations on the advisability of investing in a security or other investment property. Second, fiduciary advice broadly includes recommendations relating to the management of securities or other property. For example, management-related recommendations may include guidance with respect to an investment policy statement, investment strategies, or portfolio composition. It may also include recommendations concerning the selection of other persons to provide investment advice or investment management services. Recommendations relating to the type of investment account, for example, brokerage versus advisory, is also covered. And lastly, recommendations for the transfer or the rollover of assets from a plan or IRA to another plan or IRA account is also advice. The final rule follows the FINRA definition of a recommendation, meaning that it broadly includes any communication that, based on its context, content, and presentation, would be reasonably viewed as a suggestion that the advice recipient engage in or refrain from taking a particular course of action. I just wanted to take a minute to share a few observations about the DOL's new investment advice definition. The new definition really does broaden the scope of what fiduciary advice is. Even one-time advice that is not provided on a regular basis could potentially be viewed as fiduciary advice. Under the old definition, there is no need for a mutual understanding between the parties for which the fiduciary advice is to be provided. It is enough for a plan or IRA client to unilaterally think that the advisor is providing investment advice to trigger fiduciary status. The advice does not even need to be individualized. A recommendation will be viewed as fiduciary advice if it addresses the particular needs of a client or if it merely addresses a particular investment decision. Also, the advice no longer needs to serve as the primary basis for the retirement client's investment decision as required under the old rule. Under the new rule, the client merely needs to receive the advice. Lastly, I just wanted to note that the existing definition clearly covers investment recommendations, but the existing rule did not expressly cover investment management recommendations. Because of the literal wording, certain advisors took the position that recommending investment managers, as opposed to investments, was not a fiduciary act. However, DOL officials have now clarified that investment management recommendations also constitute fiduciary investment advice. The DOL has clarified that its new fiduciary advice definition is not intended to include marketing-related statements that an advisor might make when promoting its own services. under the new advice definition, fiduciary advice includes recommendations relating to the selection of other persons to provide advice, but it does not include an advisor's recommendation to a retirement client to hire the advisor itself. In other words, an advisor who makes a hire me recommendation to a plan or IRA client will not be viewed as rendering fiduciary advice. This is a helpful clarification because otherwise an advisor's hire me recommendation could potentially be viewed as conflicted advice in violation of the prohibited transaction rules. The DOL has also clarified that under its new fiduciary advice definition, all types of rollover recommendations will be viewed as fiduciary investment advice. Merely recommending a rollover distribution from a plan will likely be viewed as fiduciary advice, even if it does not include an actual investment recommendation as how to invest the rollover proceeds after the distribution is made from the plan. In recognition of the very, very broad scope of the proposed fiduciary rule and investment advice definition, the DOL has created 6 carve-outs or exclusions from its fiduciary definition. So long as you fall under one of these 6 categories, you will not be deemed to be a fiduciary, even when providing investment-related recommendations to retirement clients. As a formal matter, the 6 exclusions include 3 exclusions from the definition of a recommendation for fiduciary advice purposes and 3 exclusions from the actual fiduciary definition itself. The exclusions from the recommendation definition include platform-related information from defined contribution plan record keepers, investment education, as well as general communications. The exclusion from the fiduciary definition is for parties who may offer incidental advice in connection with certain business activities. These excluded parties may include sellers of investment products to institutional fiduciary plan clients, swap counterparties, as well as employees of plan sponsors. Of course, these parties will not be excluded from the fiduciary definition if they affirmatively acknowledge their status as fiduciary advisors when offering their incidental advice. Exclusion 1, platform providers. This exclusion from the new fiduciary rule applies to providers of investment platforms for DC plans with participant-directed investments, such as 401k, B, and record-keeping platforms. As long as the applicable conditions are met, the platform provider would be able to market various investment funds from its platform, which in turn may be offered as investment options to plan participants. The provider would need to market these investments without regard to the individualized needs of the particular plan or its participants. The provider would also need to disclose in writing that it is not undertaking to provide impartial fiduciary advice. The platform provider would be permitted to identify investment options meeting objective criteria specified by the plan client, such as investment funds with expense ratios below a certain threshold level. However, the provider would need to disclose any financial interests that it has in any investment alternatives. If it is responding to an RFP, the provider may also identify a sample list of investment options for the prospective plan client that is based on the plan size or current investment options. Once again, the provider would need to disclose any financial interests in the identified investment options. The provider would also be permitted to provide objective financial data for investment options as well as benchmark comparisons. Exclusion 2. The exclusion for investment education under the Department of Labor's new rule is based on the existing safe harbor for non-fiduciary investment education under DOL Interpretive Bulletin 96-1. Consistent with the current safe harbor, there are 4 categories of investment-related guidance that may be provided to retirement clients without triggering fiduciary status. They include plan information, general financial investment and retirement information, asset allocation models, and interactive investment materials such as retirement calculators and questionnaires. While the existing safe harbor only covers participant education, the new exclusion applies to investment education delivered to plan sponsors and IRA owners as well as participants. For purposes of the new exclusion, the DOL has made it clear that non-fiduciary asset allocation models and interactive materials must not recommend or reference any specific investment options unless these educational tools are being provided for a DC plan with investment options that are subject to the oversight of the plan sponsor. Additionally, all similar investment options with similar risk-return characteristics must be identified and a statement explaining how more information on the investment options may be obtained. Exclusion 3. Under the new DOL rule, there is an exclusion from the fiduciary advice definition for more general communications. To qualify under this exclusion, you would need to have general communications that a reasonable person would not view as an investment recommendation. Examples would include general circulation newsletters, as well as commentary and publicly broadcast talk shows. It would also include widely attended speeches and conferences, as well as research or news reports prepared for general distribution. And it would also include general market data, performance reports, and prospectuses for investment products. Exclusion 4. Under the new DOL rule, there is an exclusion from the fiduciary definition for sellers of investment products to institutional fiduciary clients with authority over plan or IRA assets. The exclusion generally applies when the seller is acting as a counterparty in an arm's length purchase, sale, or loan transaction. The purpose of this exclusion is to give the seller the flexibility to provide incidental advice to an institutional fiduciary in connection with the transaction without itself being deemed a fiduciary advisor. For the seller to take advantage of this exclusion, the institutional fiduciary client must have at least $50 million in plan assets under management, or it must be a bank, insurance company, registered investment advisor, or broker-dealer with plan or IRA clients. To be eligible for the exclusion, the seller must inform the institutional fiduciary client that it is not providing impartial fiduciary advice. In addition, the seller must not receive any direct compensation for providing this incidental advice. The seller must also reasonably believe that the institutional fiduciary is capable of evaluating the investment risks and that the institutional fiduciary is responsible for exercising independent judgment and evaluating the transaction. Exclusion number 5. Swaps are derivative transactions, and many institutional plans utilize swaps on a routine basis these days. For example, a plan in a counterparty bank might enter into an equity swap where the parties exchange the future cash flow value of two hypothetical investments, one linked to an equity investment like the S&P 500 and another linked to an interest rate. The exclusion from the fiduciary definition for swap counterparties covers any related advice provided by swap dealers and major swap participants who are engaged in a swap transaction with plans. To qualify for this exclusion, the swap dealer or major swap participant must be acting merely as a swap counterparty and not as an advisor to the plan for purposes of the Commodity Exchange Act and the Securities Exchange Act. The swap counterparty is not permitted to receive any direct compensation from the plan. Furthermore, before providing any recommendations relating to the transaction, the swap counterparty must obtain written representations from the plan fiduciary that the client understands that the advice is not impartial fiduciary advice and the client is exercising independent judgment and evaluating the swap counterparty's recommendations. Exclusion number 6. Under the DOL's new rule, any investment advice to a plan sponsor relating to the sponsor's own in-house plan from an employee will not be deemed to be fiduciary advice. To qualify for this exclusion from the fiduciary definition, the employee must not earn any additional compensation for providing such advice beyond the employee's normal pay. Thus, even though the plan sponsor may not be will be viewed as a fiduciary to its own in-house plan, the employee individually will not be considered a fiduciary. Accordingly, the employee will be personally protected against any potential liability for any fiduciary or alleged fiduciary violations under ERISA. There is a similar exclusion for human resource employees who might provide plan-related guidance to employees. Without this exclusion, such guidance from HR could inadvertently cross the line and be viewed as fiduciary advice. To be eligible for the exclusion, the HR employee's duties must not include providing financial advice or fiduciary investment advice to plan participants. In addition, the HR employee must not be licensed under applicable securities or insurance laws, and the HR employee must not engage in the business activities which would require such licensing. Lastly, the HR employee must not earn any additional compensation in connection with any advice beyond the employee's normal pay. You need to be careful here with when and how bonuses are provided to HR and CFO type personnel in order to not inadvertently violate this rule. Trap for the unwary. Now, the final version of the DOL's new investment advice definition follows the structure of the proposed rule. However, there are a few noteworthy differences. While the proposal provided that appraisals and financial valuations of securities would generally be viewed as fiduciary advice, the DOL's final rule excludes appraisals from the definition of investment advice. However, the DOL is developing a regulatory amendment that will cover ESOP appraisals in the future. For purposes of the final fiduciary definition effective April 10, 2017, the DOL has clarified that an advisor's fiduciary services may be limited to one-time advice, provided that the advisor communicates clearly that it will not have any ongoing monitoring responsibilities with respect to the recommended investment after its acquisition. However, the DOL has indicated that when there is no ongoing monitoring, the advisor must ensure that the recommended investment is consistent with the best interest fiduciary standard to begin with. As discussed, The DOL has clarified that an advisor's hire me recommendations are not fiduciary advice. In addition, to qualify as non-fiduciary investment education for IRA clients, the DOL has indicated that asset allocation models and interactive materials for the IRA clients must not include any references to specific investment funds or securities. Because of the very broad scope of the proposed fiduciary rule, the DOL recognized that exemptive relief would be necessary for those advisors who do not currently hold themselves out as fiduciaries, but would be deemed to be fiduciary advisors after the rule change. For this reason, the DOL has created a brand new prohibited transaction exemption. But let me back up first and talk about exemptions in general. Under Section 406B of ERISA, there are prohibited transaction rules that prevent a fiduciary from providing any conflicted advice that would increase its own compensation. There are also mirror prohibited transaction rules under the Internal Revenue Code. As a result of these prohibitions, it is unlawful for a fiduciary to earn commissions or any other type of variable compensation that varies based on the particular investment that is recommended to a client. An advisor would only be permitted to earn variable compensation if it were able to qualify for an available exemption under the prohibited transaction rules. Thus, if a broker or an insurance agent were deemed to be a fiduciary to a plan or IRA client under the newly finalized rules, in order to earn commissions that vary by investment product, it would need to qualify for an exemption. To address this clear regulatory need, the DOL has created the best interest contract or class exemption. The best interest contract exemption, excuse me, we're having technical difficulties. Here we go. Thank you. The best interest contract exemption, which I'm going to refer to as the BIC exemption, or BICE for short, is designed to provide relief to fiduciary advisors who earn variable commissions in connection with the non-discretionary investment advice that they provide to their plan and to their IRA clients. The retirement clients covered by the BIC exemption include participants, IRAs, and other similar tax-qualified accounts, such as health savings accounts, Archer medical savings accounts, and Coverdell education savings accounts. They also include non-ERISA plans, such as KEO or HR10 plans and Solo K plans, as well as ERISA plans with less than $50 million in assets. I just wanted to highlight the fact that the BIC exemption does not provide any exemptive relief for variable compensation arising from the discretionary advice of fiduciary advisors. For example, let's say that an investment manager has the authority to invest an IRA client's assets in a mutual fund without client approval. If the investment manager earns any transaction-based compensation or revenue sharing in connection with such discretionary advice, the arrangement will be a violation of the prohibited transaction rules, and the BIC exemption will not apply because the investment manager's advice is discretionary. The best interest contract exemption is a complicated exemption because it includes 4 sets of alternative conditions that apply based on your client type and other circumstances. First, you have the full-blown BIC, which applies to IRAs and non-ERISA plans, where you must have a written contract in place with the client. Next, you have disclosure BIC, which applies to ERISA plans where written contracts are not required specifically. And then you have the streamlined BIC for level fee fiduciaries who do not earn any variable compensation in connection with their advice. Lastly, you have the transition BIC with simplified requirements that are only available for the 2017 transition period. Now, these names I have placed in quotes, like full-blown and streamlined, because they're based on my own personal naming convention, and they are not actually used in the DOL rule. But as you see, these informal names will help us keep straight the alternative requirements, and I do believe they will become industry standard terminology. You heard it here first. Now, in theory, simply rely on the full-blown version of the BIC for all plan and IRA clients as of April 10, 2017, when the new fiduciary rule kicks in. But as a practical matter, it would be beneficial to use the other, less onerous BIC versions for different client types, and we would expect many firms to utilize all 4 versions of the BIC. The full-blown BIC and its requirements apply to a firm's IRA and non-ERISA plan clients. It requires a written agreement between the fiduciary advisor and a new client, and the contract generally must be executed before or when any recommendation is executed. The agreement must contain certain mandatory provisions and warranties. The agreement by its terms must reflect the relevant fiduciary standards, and it must also include general disclosures concerning the advisor's compensation and any related conflicts. Specific compensation information relating to any recommended investment products must be provided upon request by the client. The agreement must include a warranty that the plan has adopted compliance policies designed to mitigate conflicts. The contract is permitted to provide for mandatory arbitration with a reasonable venue for the client, but it must not limit the client's right to participate in class action lawsuits. In addition to the written contract, the firm generally must also provide transaction disclosures for each and every recommended investment. The transaction disclosures generally focus on the fiduciary standards and the advisor's conflicts. New transaction disclosures do not have to be provided for 1 year in the case of recommendations to purchase more of the same investment product. And last but not least, the advisor must post web page disclosures focusing on the firm's business model and its related conflicts. The disclosure BIC and its slightly easier requirements are available to advisors when serving ERISA plan clients. In general, the disclosure BIC requirements mirror those of the full-blown BIC. However, no written contract is required. Instead, a written statement of fiduciary status and general disclosures on the advisor's compensation and conflicts must be provided. Other than this one difference, the disclosure BIC requirements are pretty much the same as the full-blown BIC requirements. In addition to the written statement and general disclosures on compensation and conflicts, for purposes of the disclosure BIC for ERISA plan clients, you still need to provide specific compensation information relating to any recommended investment products upon request. The firm must adopt compliance policies designed to mitigate conflicts. Transaction disclosures generally focusing on the fiduciary standards and the advisor's conflicts are required for each recommended investment. And web page disclosures focusing on the plan's business model and its related conflicts are also required. I want to focus on the compliance policy requirement under the full-blown BIC for non-ERISA plan and IRA clients, as well as the disclosure BIC for ERISA plan clients. The DOL has clarified that the firm's compliance policies must impose restrictions on any differential compensation that is paid from the broker-dealer to its associated reps. Specifically, a BD firm cannot pay more to a rep simply because the recommended product generates a higher commission. Any differential compensation paid to the rep must be based on neutral factors tied to differences in services that arise when different categories of investments are recommended, such as the additional time or expertise needed to sell a particular investment category. The DOL appears to be expecting broker-dealers to change their payout grids for reps. For example, according to the DOL, a rep would be permitted to receive a higher payout for selling a VA or variable annuity in comparison to another type of product if more time and expertise is needed to sell the VA contract. However, it appears that the payout for all VA contracts would need to be levelized, assuming that the time and expertise needed to sell one VA product is the same for all other VA products. This requirement is designed to ensure that the rep does not have an improper incentive, for example, to steer clients to a particular VA product. There is a separate DOL filing requirement that is imposed under the full-blown BIC for non-ERISA plan and IRA clients, as well as the disclosure BIC for ERISA plan clients. A one-time notice must be filed with the DOL before a firm may receive any variable compensation in reliance on the full-blown BIC or the disclosure BIC. The notice does not need to identify the firm's plan clients or IRA clients. And the good news is that this notice filing with the DOL does not need to be approved by the DOL. Accordingly, there is no substantive approval process or waiting period once the notice is filed. This is not intended to be an onerous requirement, but in the end, it will require thousands of firms to submit regulatory notice filings to the DOL when they begin relying on the full-blown BIC or the disclosure BIC. And it does indeed appear that the DOL will be compiling this information for investigative and other related enforcement purposes. The streamlined BIC exemption is for level fee fiduciaries who do not earn any variable compensation. Many level fee fiduciaries, such as RIA firms, have assumed that they will not need the BIC since they do not earn any variable transaction-based compensation. However, the DOL has clarified that level fee fiduciaries will indeed need the BIC if they have an existing plan sponsor client and they also offer rollover advice to participants for a higher fee. They will also need the BIC if they offer rollover advice to off-the-street participants where there is no pre-existing relationship with the plan. Finally, they will need the BIC when recommending existing retirement clients to transition from commission-based to fee-based arrangements. For example, let's assume that a broker has sold an A-share mutual fund to an IRA client. The broker has already received a front-end sales load and is now earning an ongoing trail of 25 basis points. If the rep were to transition the IRA client to an advisory relationship with an ongoing fee of 100 basis points, you would need the BIC to cover the higher ongoing fee. Fortunately, The streamlined BIC requirements are somewhat simple. The advisor must provide a written statement of fiduciary status. The reason for the rollover recommendation being in the best interest of the client also needs to be documented internally, but there is no need for compliance policies or other disclosures. The transition BIC is available to fiduciary advisors and their plan and IRA clients for the transition period beginning April 10th, 2017, when the new definition goes into effect, through January 1, 2018. The transition BIC is optional, but it may be beneficial for firms that are not yet ready to comply with a full-blown disclosure or streamlined BIC by April 10. The good news is that many of the regular BIC requirements are in fact waived for the transition period through January 2018. Under the simplified requirements, the transition BIC simply requires the advisor to provide a written statement of fiduciary status and conflict disclosures. The information may be provided electronically or by mail. A person or persons who will be responsible for monitoring compliance with the new fiduciary standard must also be designated. Again, this is my own personal naming convention, but I informally refer to this person as the BIC or the BICE officer. Although BICE officers need to be designated under the transition BIC by April 10, there is no need to adopt any BIC compliance policies or any other disclosures. I think you can see that BICE officers will create, I think, a cottage industry, and the terminology will likely, again, become industry standard. Again, you heard it here first. Grandfathering. The DOL has provided grandfathering relief for any ongoing commissions that are earned by broker-dealers on investment products that were recommended prior to the effective date of the new fiduciary rule, basically April 10, 2017. In sum and in general, the BD firm and the rep may continue to earn commissions on these grandfathered investments if certain conditions are met. When the grandfathered investment was originally sold to the client, the sale transaction must have been in compliance with the prohibited transaction rules. The compensation earned by the advisor must be reasonable. There is no grandfathering relief for any investment recommended after April 10, 2017, including additional purchases that are recommended for the same grandfathered investment. For example, let's assume that a VA contract is a grandfathered investment sold to a retirement client prior to April 10. If the advisor recommends additional deposits under the same contract after this date, any commissions generated by this new recommendation would not be grandfathered, and you would need the BIC exemption. As a formal matter, the grandfathering rule is part of the BIC exemption, and frankly, it's somewhat troublesome on its face. If an advisor no longer provides any advice to the client after April 10, it is unclear if the ongoing commissions earned from the grandfathered investment would qualify as reasonable compensation under the grandfathering rule. Hopefully, the DOL will provide further clarification on this point. The final version of the BIC exemption is similar in structure to the DOL's proposed version, but numerous changes have been adopted and incorporated into the final BIC exemption. These changes are beneficial in that they are designed to improve the administrative feasibility of complying with the BIC. Written contracts are no longer required for ERISA plans, which is now covered under Disclosure BIC. The proposed version of the BIC exemption initially required projected cost charts and annual fee activity statements, but these disclosure requirements have been dropped in the final version. specific compensation information had to be posted on the firm's web page disclosures under the proposed version, but the final BIC exemption only requires specific compensation figures to be provided on request. The final BIC exemption also clarifies that BIC relief is necessary when level fee fiduciaries solicit rollovers from off-the-street participants, even when there is no pre-existing relationship with the plan. It also clarifies that differential compensation for registered reps of BD firms is only permitted if they are based on neutral factors. As you can see, while administrative feasibility has been improved, the BIC exemption still imposes some fairly heavy requirements. The BIC exemption is a very interesting piece of rulemaking indeed. As a technical matter, the DOL is responsible for defining what a fiduciary is for both plans and IRAs, and it is also responsible for granting exemptions for both plans and IRAs. However, the IRS generally has exclusive enforcement jurisdiction over IRAs. If an advisor were to violate its fiduciary duties to an IRA client, the DOL would have no enforcement power over the advisor. In recognition of this fact, the BIC exemption effectively gives IRA owners the contractual power to enforce any fiduciary violations made by an advisor. By requiring the inclusion of the best interest fiduciary standard in written contracts under full-blown BIC, the DOL has effectively handed off its enforcement responsibilities to IRA investors themselves and, importantly, to the plaintiff's bar. The BIC exemption is expected to have a huge impact on broker-dealers. Even if you don't have any plan clients, the BIC exemption will still affect private wealth management clients who have IRA money. The required disclosures may be somewhat burdensome, but I suspect that many BD firms will find it especially difficult to adopt compliance policies that eliminate all incentives that encourage improper advice as required under the exemption. Now that the rule is finalized, the DOL is expected to provide additional guidance on compliance policies before the BIC is fully phased in on January of 2018. Given the popularity and the importance of annuity products in the retirement industry, I wanted to take a moment to discuss the special treatment of annuity products under the DOL's final rule. As everybody knows, annuity products are routinely sold through brokers and insurance agents who earn commissions in connection with their sales recommendations. Commissions are customarily earned with sales of fixed annuities, fixed indexed annuities or FIAs, and variable annuities or VAs. Once the new DOL rule becomes effective in April, virtually all insurance brokers and agents will be deemed to be ERISA fiduciaries. The problem is that commissions are a form of variable compensation, since they vary by annuity product. Therefore, as fiduciary advisors, brokers and agents will need an exemption in order to earn commissions from annuity sales. The good news is that BIC exemption is very powerful and can be utilized for all types of annuity sales in exchange for variable compensation. In addition, PTE 8424 is an alternative exemption with far less onerous conditions, but it only covers the sale of fixed annuities. PTE 8424 is an old exemption, well, from 1984, that is designed to give fiduciary advisors the ability to earn commissions when recommending annuity products to plan clients. Under the DOL's final rulemaking, PTE 8424 has been modified. The upside of this exemption is that it is much easier to satisfy than the BIC exemption. For example, unlike the BIC exemption, PTE 8424 does not require a written contract with non-ERISA plan and IRA clients, and no compliance policies are required. But the downside is that 8424 will not cover FIA or VA sales to an advisor's retirement clients. In addition, it only provides relief for commissions and does not permit the receipt of other forms of variable compensation, such as revenue sharing payments from insurance companies. In general, it requires advisors to disclose their conflicts. The advisor must also disclose its commissions. In the case of ongoing deposits that are made under the same annuity contract, new disclosures would have to be repeated on an annual basis. The client must also provide written authorization of the annuity purchase and acknowledge receipt of the required disclosures from the advisor. There is a big difference between the version of PTE 8424 as proposed by the DOL in April 2015 and the final version. While the final version covers fixed annuities only, the proposed version had covered fixed indexed annuity sales to plans and IRAs as well as VA sales to plans. Additionally, instead of requiring annual disclosure in the case of ongoing deposits under the same annuity product, the proposal had required the disclosures to be provided every 3 years. In the final version of 8424, the DOL also clarified that the required commission disclosures must break out the separate amounts payable to the individual advisor and to the firm. The disclosed commissions must also be expressed as a flat dollar figure if feasible to do so. If not, the commissions must be expressed as a percentage of the premium payments. Although PTE 8424 does include a number of technical requirements, on the whole, they are more easy to satisfy than the requirements under full-blown BIC or under disclosure BIC. I wanted to take a moment to talk about fee levelization since there's been a lot of buzz about it. In short, fee levelizing is just another way to comply with the prohibited transaction rules. For example, instead of using the BIC exemption or PTE 8424, a firm could always levelize its commission-based compensation in order to avoid a violation of the PT rules. Levelizing is not an official exemption, but it is helpful to think of it as a de facto exemption. It eliminates variable compensation and stops any prohibited transaction from happening in the first place. For example, let's say that an advisor commits to recommending IRA investments that generate a level asset-based commission of 50 basis points. Under this approach, the advisor would recommend an investment product such as a VA that pays a 50 basis point trail, and the retirement client would not have any worries about getting pushed into a different investment with a higher payout for the advisor. Of course, if you were to move ahead with the fee levelized approach as a way to avoid a prohibited transaction, it would be critical to identify any other form of variable compensation. For example, in addition to commissions, you would need to address all other forms of compensation that could potentially be paid to the individual advisor or the firm in connection with the investment product. The first step in implementing fee levelization is to identify any and all forms of variable compensation that are in play. This includes the compensation that is payable to the individual advisor, such as any commission-based compensation and ticket charges. Revenue sharing may be payable from product sponsors, such as mutual fund families and annuity providers, and these payments would be viewed as variable compensation to the extent they are based on sales or on assets. if the firm maintains custody, investment fund products, or even clearinghouses may pay sub-transfer agency or sub-TA payments that vary by fund product. A firm may also have proprietary investment products, such as sweep vehicles, where the firm earns an internal investment fee on top of the transaction-based compensation. Once all forms of variable compensation have been identified, they would need to be restructured to ensure that no amount varies based on which particular investment product is sold. For example, if the client agrees to pay 50 basis points, you would need to ensure that there is an appropriate universe of investment products that generate a commission of 50 basis points. No additional fees may be generated, such as revenue sharing, although you would be able to restructure any revenue sharing payment so that they are flat dollar amounts that do not vary on sales or on assets. As a general rule, proprietary products don't work with fee levelization, which means either you have to eliminate proprietary products or provide a fee credit that eliminates any financial incentive to include them. Robo advice. In recent years, Robo advice has become a popular investment service for plans and for plan participants. Given the additional compliance costs that may be associated with servicing retirement clients after the DOL rule goes into effect, many people are considering robo-advice as a potential investment solution for retirement accounts, especially smaller client accounts. So what then is robo-advice? Well, providers of robo-advice generally provide asset allocation advice based on a computer model. They are routinely offered to and used by participants to help them determine investment allocations for their plan accounts. Although robo-advice providers have historically focused on servicing plan clients and plan participants, similar models can be utilized by IRA clients as well. The computer models typically use mean variance optimization, which is a quantitative tool that is used to identify portfolios with optimally diversified allocations for a preferred level of risk. So-called MVO models are based on the real pioneering work of Harry Markowitz, who is a Nobel Prize-winning economist. Many computer models also use Monte Carlo simulations to model the different portfolio outcomes for a given investment allocation strategy, as well as the probability of these different outcomes. Robo-advice is of particular interest right now because there is an associated exemption from the prohibited transaction rules. The exemption is based on historical regulatory guidance from the Department of Labor that has evolved over the years. In 1997, the DOL initially issued PTE 97-60, which is sometimes referred to as the TCW exemption. On a personal note, I helped create and shape this novel exemption and was the lead author. It gives the fiduciary advisor the ability to recommend affiliated funds as long as the recommendations were made by an independent financial expert. In 2001, the DOL then released Advisory Opinion 2001-09A, which is referred to as the Sun America Opinion. This opinion gave the fiduciary advisor, the ability to recommend its own affiliated funds as long as the allocation advice was generated by an independent computer model. With the enactment of the Pension Protection Act of 2006, a related statutory exemption was created called simply the computer model exemption. The computer model exemption is powerful in that it allows fiduciary investment advisors to receive all forms of variable compensation including commissions such as 12B1 fees, as well as additional levels of compensation earned from proprietary product. In order to rely on the computer model exemption, the advice must be limited to non-discretionary advice that is based on a qualified computer model certified by an independent expert. Investment advice based on a computer model qualifies under the PPA's exemption only if the computer model applies generally accepted investment theories that take into account the historic risks and returns of different asset classes. The model must not inappropriately favor proprietary investments or any other investment option that may generate greater income for the fiduciary advisor. The computer model must request and utilize relevant information from a plan participant or an IRA owner, such as age, risk tolerance, expected retirement, time frame, etc. The model must also take into account all designated investment options under the plan. The computer model needs also to be certified by an investment expert that is independent of the developer of the model. Whenever the computer model is materially modified, it needs to be recertified. In addition to the certification requirement, the computer model arrangement must be audited by an independent auditor on an annual basis. We're actually starting to do this more and more. Written disclosures must also be provided, and the computer model arrangement must be authorized in writing by the plan or the IRA client. The compensation earned by the fiduciary advisor and its affiliates must be reasonable. Rollovers. Now we need to turn our attention to one of the major targets of the DOL fiduciary proposal, and we can see how this is with respect to the rollover of plan assets. In order to understand what needs to be done to capture rollovers now and in the future, we need to explore ERISA's limitations and restrictions on cross-selling. Cross-selling practices, by their very nature, create potential conflicts of interest. It is easy to see the potential abuse that can arise when a firm or a business exploits the trust which has developed with a client through a long-standing relationship to sell additional products and services at potentially unfavorable terms to the client. Capturing rollover assets is a classic example of cross-selling. In many instances, an advisor will have developed long-standing relationships with both the plan sponsor as well as the plan's participants over the years. It would be tempting then for the advisor to encourage the plan's participants to roll over their account balances to IRAs as soon as they become eligible to take a distribution. This temptation arises whenever the advisor can earn a higher level of compensation providing rollover IRA services to the participant than the level of plan-related compensation that would otherwise be earned. To curb potential abuses associated with capturing rollovers, the DOL issued Advisory Opinion 2005-23A, which I call the rollover opinion. On its face, this interpretive guidance broadly suggested that any rollover-related advice from an advisor providing any fiduciary advice to the plan sponsor or the plan's participants could result in a prohibited transaction. On the other hand, an advisor who did not serve as a fiduciary could freely advise participants on rolling over their accounts to IRAs and how the rollover proceeds should be invested. However, consistent with the rollover opinion's reliance on the Supreme Court decision in Verity v. Howe, many believe that an advisor currently engaged to provide plan-level fiduciary services would not be acting as a fiduciary when acting in a wholly separate non-fiduciary capacity, such as selling personal rollover services unrelated to its status as a fiduciary. The DOL's new fiduciary rule, however, supersedes and replaces the DOL's existing rollover guidance as articulated in Advisory Opinion 2005-23 Cap A. In contrast to this rollover opinion, under the DOL's new and broader definition of fiduciary advice, any and all rollover recommendations would generally be viewed as fiduciary advice. In fact, a recommendation for a participant to take a rollover distribution would be viewed as fiduciary advice even if the advisor does not include any actual investment recommendations along with the rollover recommendation. The resulting rollover advice would then automatically cause the advisor to become a fiduciary to the plan or to the IRA. In the case of financial advisors who earn commissions, they would need to comply with the full-blown BIC requirements when soliciting rollovers. The BIC exemption would provide relief if the commission-based advisor earns a higher level of compensation as a result of the rollover, and it would also provide relief for any commissions that are earned on rollover IRA assets. Fee-based advisors will also need to rely on the BIC exemption, the streamlined exemption, when offering rollover advice. As discussed under the new DOL rule, when an RIA with an existing plan client offers rollover advice to plan participants, it would be customary for the RIA to earn a higher rate of compensation from the rollovers. For example, an RIA may earn 50 basis points for advising a plan, but 100 basis points from rollover IRA assets. Under the DOL's final rule, the RIA would need the BIC exemption in order to earn a higher rate of compensation for providing rollover advice. Fortunately, the streamlined BIC would be available to RIAs in their capacity as level fee fiduciaries. As discussed earlier, the streamlined BIC could also be used when RIAs offer rollover advice to off-the-street participants. RIAs may also need to comply with the BIC exemption when it comes to retail managed account programs. If a program sponsor or advisor earns any kind of variable compensation from its IRA or plan clients under its managed account program, they would need BIC relief. In addition, solicitors who refer IRA or plan clients to a managed account program would be viewed as fiduciary advisors earning a referral fee under the DOL proposal. Referral fees would generally be viewed as variable compensation tied to a referral, so solicitors would also need to comply with the BIC exemption once the new rule goes into effect in April of 2017. Managed account programs are tricky in that there are so many moving parts. For example, many programs have multiple investment managers that are accessible to program clients. Because the DOL's fiduciary rule is so broad, an advisor's recommendation to a client to select a particular investment manager would be viewed as fiduciary advice relating to the management of the client's investment account. In many advisory programs, variable compensation may arise to the extent the advisor can increase its net compensation by recommending a cheaper investment manager. For example, let's assume that the gross fee for managed account services is 100 basis points. If an investment manager charges 30 basis points for its services and there are 20 basis points for other costs, the net compensation for the firm would be 50 basis points. However, the firm could potentially increase its net compensation by recommending a cheaper investment manager that charges, let's say, 15 basis points rather than 30. As you can see, if model providers charge different amounts for their services, the firm sponsoring the managed account program may and probably will have variable compensation issues. Other potential sources of variable compensation include revenue sharing payments as well as commissions and ticket charges in the case of non-wrap fee advisory programs. If a managed account program has variable compensation issues, the program sponsor and advisor could always rely on the BIC exemption. The BIC exemption would give fiduciary advisors, including the program sponsor, the ability to earn variable compensation when providing advice through managed account programs. However, one big weakness of the BIC exemption is that it does not provide relief for variable compensation arising from discretionary advice. The BIC exemption only covers providers of non-discretionary advice, and the problem is that many managed account programs involve the delivery of discretionary investment advice. If the BIC exemption is not available, the managed program may need to be modified so that there is fee levelization for the participating fiduciary advisors. In fact, firms may wish to explore using a combination of the BIC exemption and fee levelization as a compliance strategy for their managed account programs. For example, the BIC exemption may be utilized for programs that feature non-discretionary advice and fee levelization for programs that feature discretionary advice. For fee levelization purposes, revenue sharing payments from third-party firms may be restructured so that they are based on factors that are not related to sales, such as level of access to the third-party firm that will have and employ the program sponsors' individual advisors. Trends. It is always difficult to predict what the longer-term implications of any regulatory change will be. But we can be certain that the broker-dealer industry and the wirehouse industry will be thinking strategically about the DOL's new fiduciary rule. Here are different courses of action that many firms will be considering. To avoid the BIC exemption and its requirements, firms are likely to explore levelizing commissions and structuring their revenue sharing payments as flat dollar amounts. We can also expect more registered reps to migrate to an advisory service model, which may or may not be revenue neutral for hybrid RIA firms. Presumably, they will also modify their advisory programs so that they utilize institutional mutual funds and variable annuities. We can also expect firms that sponsor retail SMA programs to modify them to rely on BIC exemption, fee levelization, or a combination of both. Broker-dealer firms are likely to reduce the investment minimums in their advisory programs to accommodate smaller retirement accounts that were previously advised by commission-based compensation. Firms may also develop robo-advice solutions or explore partnering with robo-advice providers so that their reps will have an appropriate investment solution for clients with smaller accounts. By relying on the computer model exemption, these reps may be able to continue to earn commission-based compensation for smaller accounts. Given the volume of the work that is required, firms should start preparing for the new fiduciary rule now, or frankly rather, yesterday. For example, you should be identifying all investment products and advisory services that are currently being distributed to your plan and to your IRA clients. Many firms have retirement client accounts that are held direct at their mutual fund company or held away on 401k record-keeping platforms and that are not custodied in a brokerage account. In these situations, you should ensure that you have adequate supervisory control over plan and IRA accounts. Firms should also be identifying all instances of variable compensation that would be deemed to trigger unlawful prohibited transactions. You should also be making strategic plans with ERISA counsel as to whether you will be relying on the BIC exemption, PTE 8420 fee levelization, or some other exemption. If you plan to take advantage of the simplified requirements under the transition BIC, you will need to provide the required disclosures to clients on April 10th, 2017. A BIC officer will need to be designated by this date. As you may want to be talking to potential BIC officers now, by the way. As of January 1, 2018, the full-blown BIC requirements will apply, and written contracts will be required for all of your IRA and non-ERISA plan clients. Fortunately, the DOL has clarified that these clients may adopt the required agreements through a negative consent process. In general, broker-dealers, RIAs, IRs, financial advisors, wirehouses will need to upgrade their systems, procedures, and compliance policies to comply with the requirements of the BIC exemption, which really is the centerpiece of the DOL's new rule. Firms will need a toolkit to help them meet the numerous requirements. Specifically, the firm will need model client contracts for full-blown BIC and model disclosures for disclosure BIC. They will also need to adopt model transaction and web page disclosures. Firms will also need to adopt compliance policies designed to mitigate all conflicts of interest, and they should also consider making changes to their payout grid for individual advisors so that their differential compensation is based on neutral factors. Systems will also need to be developed so that specific compensation figures for any recommended investment can be made available on demand by clients. Lastly, the firm should also provide education and training to their advisors relating to the new fiduciary standard of care, the various requirements under the PIC exemption, as well as the firm's new compliance procedures. As firms continue and consider their procedures and processes for implementing the BIC exemption, they may also wish to consider the strategic use of financial plans. Once the rule goes into effect, advice from commission-based advisors will be subject to a higher fiduciary standard. For this reason, BD firms may wish to consider using financial plans to ensure that the rep's recommendations are in the best interest of the retirement client. Quality financial plans by their nature force the rep to consider the client's full financial picture and can help demonstrate that the advisor's recommendations are being made with procedural prudence. It's time to wind up our discussion of the DOL's new fiduciary rule, and I hope you were able to see the DOL's big picture policy goals. In the end, the DOL is seeking to impose a universal best interest fiduciary standard on all types of advisors to plan sponsors, participants, and IRA owners. There's a certain degree of irony in the DOL policy goals. The new regime effectively creates two classes of fiduciary advisors, those earning variable compensation and those who do not. The DOL's new rule is expected to affect substantially all advisors, even if they don't have plan clients, because of the rule's reach to IRA assets. This is why so many people are referring to this rule as a real game changer. The DOL's new rule is also going to impose significant compliance costs on broker-dealers, insurance agencies, and other firms. It won't be easy to prepare for the DOL's new rule, but based on the changes that were adopted and integrated into the final rule, it looks like the new requirements are at least workable. Plan sponsors should be prepared for serious and extensive discussion with their vendors regarding the new rule. The DOL is expected to release additional guidance in the upcoming months, and you should, of course, stay on the lookout for any new releases. And with that, I turn it over to my colleague, Ari Sonnenberg.
Thank you, Marcia. That was extremely informative, and thank you everyone for attending this webinar. A recording of the program will be available shortly on the Wagner Law Group website, and please do not hesitate to contact Marcia or any of the attorneys at the Wagner Law Group directly if you have any questions. Thank you very much.